Welcome to the Chapter 17 video on other rollovers. In this video, we're going to focus on three main sections of the Income Tax Act, 85.1, 86, and 88.2. Moving on to the next slide, let's focus on 85.1 first. Now, 85.1 is known as a share-for-share exchange. So moving on, let's talk about a common application of 85.1. Now, the most common application is, for example, a big public company wants to acquire another corporation. And so rather than buy the shares from the shareholders of that other corporation, they can approach the other shareholders and do what's called a Section 85.1 share-for-share exchange. And with the Section 85.1 share-for-share exchange is an automatic application. There's no election forms that are required. So let's take a look at the example on the slide here. Let's focus on before, on the left side. So before the Section 85.1, Ms. May owns 100% of May Limited. Now, Ms. May owns shares, let's say common shares in May Limited, and currently those common shares have a fair market value of $700,000. The adjusted cost base and PUC are $100,000. So if there was a big public company that wanted to take over May Limited, Ms. May could sell the shares directly to the large public company. However, she would then have to report a capital gain and pay taxes on the sale of the share. So with an 85.1, if we look on the right side, Ms. May could exchange her common shares in May Limited, give those to Acquirer Limited, the big public company, and in return, she's going to get common shares of Acquirer Limited. And so once again, this can all be done on a tax-free basis. Ms. May will not have to record any capital gain and will not have to pay any taxes. So that's a simple application of 85.1. Let's actually look at the details on the next slide. So I've just recreated the diagrams on the previous slide, so we have those here. Let's talk about what happens to Ms. May. Well, there's no capital gain. The proceeds of disposition on the sale of her May Limited common shares to Acquirer Limited will have proceeds equal to the old ACB of the shares that she gave up. So there's going to be no capital gain. Proceeds of $100,000 minus ACB of $100,000. There's going to be no capital gain. Now the ACB of the new shares that she gets of Acquirer Limited will take on the ACB of the old shares. So the new shares that she has of Acquirer Limited will now have an ACB of $100,000. What about the PUC? Well, the PUC of the new shares will also equal the old PUC, which is $100,000. So fairly straightforward. And the ACB of the May Limited shares that Acquirer Limited now owns will be the lesser of the fair market value and the PUC. And once again, the PUC is the lesser of the two amounts. And so Acquirer Limited that now owns the May Limited shares will hold those at an ACB of $100,000. So actually everything is just going to transfer free of tax. Moving on to the next slide, we're going to just focus on the conditions required for a Section 85.1. Now there are strict conditions that are required. The shares that are being transferred must be taxable Canadian property. The purchaser must be a taxable Canadian corporation. So in our previous example, Acquirer Limited, who is the purchaser, Acquirer Limited must be a taxable Canadian corporation. The consideration must be shares of a single class. It can't be multiple different classes of shares. And the relationship between the two parties must be at arm's length. So in our previous example, Ms. May and Acquirer Limited, they must have an arm's length relationship. Also, the vendor, Ms. May in our previous example, after the Section 85.1 cannot control the purchaser. So that's also another condition that's required in order to meet the Section 85.1 conditions. Now, there cannot be a Section 85 election filed in conjunction with an 85.1. So if you remember back in Chapter 16, that's where we covered Section 85 rollover. So you cannot use a Section 85 in conjunction with an 85.1. And once again, there's no gain, there's no loss recognized. Everything is done on a tax-free basis. Moving on to the next slide, let's talk about Section 86. Now, Section 86 deals with exchanges of shares in a reorganization. So moving on to the next slide, let's talk about the common application of a Section 86. This often is used in what we call an estate freeze. We have the current shareholder or shareholders of a corporation. So let's assume that the current shareholder is the parent. The parent has this corporation that they've owned and grown for many, many years. And now they want to retire. And they want to pass the corporation on to, let's say, one of their children, or maybe to a key employee that's been vital to the success of the corporation. With a Section 86, it's simpler to implement than a Section 85. So usually a Section 85 can be used to accomplish the same things that a Section 86 does. However, a Section 86 is just easier. There's no second corporation that's required, and there's usually less legal steps. Now also, there's no election form required for a Section 86. Now remember, back in Chapter 16, a Section 85 requires an election form to be filed with the CRA. That is not the case for a Section 86. However, there are some disadvantages. One of those is that with a Section 86, the current shareholder must exchange all the shares of that particular class. So let's say once again we have this parent, they want to retire, they want to pass on the corporation, let's say, to one of their children, but they don't want to actually trigger any taxes. So a Section 86 can be used to accomplish that. However, with a Section 86, because there is an exchange of shares, that parent has to exchange all of their current shares. For example, out of their current common shares, they cannot retain some of those common shares. Now, also with a Section 86, there's not a range of elected values. If you remember back in Chapter 16 with a Section 85, there was this range of values that the taxpayer could elect from. That is not the case with a Section 86. Let's move on to the next slide, and let's take a look at, once again, some of the more detailed steps of a Section 86. With a Section 86, the current shareholder is basically going to give up their current shares. Let's assume that those current shares are common shares. Those are growth shares. All the growth is attributed to the common shares. So that parent is going to give up their old shares, let's say their common shares, and in return, they're going to get shares of a different class, probably preferred shares. Now, preferred shares are usually referred to as non-growth shares. Now, in return, they could also get boot, also known as non-share consideration. And once again, boot could be, for example, cash. It could be a note. Once again, anything that is non-share can be given back to the existing shareholder. That amount would be referred to as the boot. So the current shareholder is going to give up all their old common shares in return for new preferred shares, and they may also get back some boot from the corporation. Now, boot may be taken up to the ACB of the old shares that are being given up with no immediate tax complication or no immediate tax implications. If boot is taken back by the shareholder in excess of the old ACB of the old shares, then there could be a deemed dividend and also a capital gain or capital loss. Now, the ACB of the boot, so the shareholder that's going to give up the common shares, they're going to get back preferred shares and possibly some boot. The ACB of the boot will be equal to the fair market value. The ACB of the new shares, for example, the preferred shares that the shareholder gets back, will equal the ACB of the old shares minus the boot. And the puck, there's going to be a puck reduction of the new shares. You work through the puck reduction, and that's going to give you the reduction to the puck. Now, there's also going to be a redemption. So if you think about this, the shareholder is going to give up their old shares. And so in a sense, the corporation is going to redeem those shares from the shareholder. The proceeds of redemption will equal the boot that the shareholder receives plus the puck of the new shares. There's also going to be a disposition, and that's going to equal the boot plus the ACB of the new shares. And that's going to be used to determine whether there's going to be a capital gain or capital loss. So that's sort of the more detailed steps of a Section 86. Now let's actually look at this example for a Section 86. So we have Shirley. Shirley owns 100% of the common shares of Foley Inc. The common shares that she owns have a puck and ACB equal to 100,000. The fair market value is $1 million. So Shirley has owned Foley Inc., let's assume for a number of years. Now she wants to retire, but she doesn't want to trigger any, let's say, capital gain and pay taxes. And let's say she wants one of her children to take over Foley Inc. So under a Section 86, she's going to give up her Foley Inc. shares that have a puck and ACB of 100,000, but she needs to take back value equal to the fair market value of those shares. The fair market value of those shares is $1 million, so she's going to take back boot, which is the note of 75,000, and also preferred shares that have a value of 925,000. So the total value that she gets back must equal the fair market value of the shares that she's going to give up. And so once again, if she was to sell those shares, let's say to another party, she would be triggering a capital gain of $900,000. The fair market value minus the ACB, that would be the capital gain. So under a Section 86, if she takes back boot equal to or less than the ACB of the shares she's going to give up, then there will be no immediate tax consequences. So once again, let's just take another look at this. Shirley owns Foley Inc. She's going to give up her common shares that have a fair market value of $1 million and take back $1 million worth of assets. And those assets consist of a note of 75,000, that's known as the boot, and preferred shares of 925,000. Now, these preferred shares are referred to as the non-growth shares. So those preferred shares will not grow as fast or hardly at all compared to the common shares. Now, the one thing with this example is that we don't have that third party, let's say the child, for example, that's going to buy the common shares in Foley Inc. We're just going to focus on Shirley, who's going to give up her common shares and get back preferred shares and boot. Now, she's going to, once again, exchange her common shares and get back preferred shares and the note. Let's move on to the next slide and take a look at the tax implications. Now, the ACB of the note that Shirley now holds is equal to the fair market value. And so once again, remember we said that if she takes back boot less than the ACB of the shares she's going to give up, there's going to be no immediate tax consequences. So let's actually confirm that. Now, the ACB of the new shares, remember those new preferred shares that she's going to get, that's going to equal the ACB of the old shares, 100,000, minus the boot that she took out. And so the ACB of the new shares is going to be 25,000. Now there's going to be a puck reduction, and if we work through the puck reduction, the puck of the new preferred shares will also equal 25,000. Now the proceeds of redemption, remember Foley Inc. is going to redeem the common shares from Shirley. So first of all, we got to figure out what the proceeds of redemption is. That's going to equal the boot, 75,000, plus the puck of the new shares, 25,000. So the proceeds of redemption are going to be 100,000. And then the proceeds of disposition, boot, 75,000 plus ACB of the new shares, 25. The proceeds are going to equal 100,000. Now, because the common shares that Shirley gave up had a PUC and ACB equal to 100,000, there's going to be no deemed dividend, there's going to be no capital gain, no immediate tax consequences. So moving on to the next slide, once again, no deemed dividend. The 100,000 proceeds of redemption that Shirley is deemed to have received minus the PUC of the old shares, there's going to be no deemed dividend. Also, there's going to be no capital gain. Proceeds of disposition, 100,000, minus the ACB of the old common shares, 100,000, no capital gain as well. Now, what happens in the future? So right now, Shirley holds the note for 75,000 and the preferred shares. Now, remember, the preferred shares, their fair market value is 925,000, but the ACB and PUC are both 25,000. So let's say in the future there's a redemption of the preferred shares for 925,000. So let's say the corporation redeems the preferred shares from Shirley in the future for, let's say, 925,000. First of all, there's going to be a deemed dividend. That deemed dividend will be proceeds of redemption for 925 minus the PUC of 25, and so Shirley will have a deemed dividend of 900,000. There will also be a disposition. The proceeds will equal the 925,000 minus the deemed dividend of 900,000. So the proceeds of disposition will be 25,000 minus the 25,000 ACB, and so there's going to be no capital gain. So if in the future Foley Inc. redeems the preferred shares from Shirley at 925,000, Shirley will then have a deemed dividend of 900,000. Now, what if in the future Shirley sells the preferred shares to a third party at fair market value? Then she'll have a capital gain. Remember, the proceeds of redemption, the deemed dividend up above, that's only applicable if Shirley is interacting with the corporation Foley Inc. What could happen in this last example on the slide here is if she sells the shares to a third party, arm's length party, for 925,000, there's no deemed dividend, PUC is not relevant, she would just have a capital gain, proceeds of disposition 925,000 minus the ACB of 25,000, she will have a capital gain of 900,000, of which 50% is taxable. So that's an example of a Section 86 share for share exchange. Let's move on to a Section 88.2. Now, a Section 88.2 is referred to as a wind-up of a Canadian corporation. So let's talk about the common application. Let's say we have a shareholder or shareholders of a corporation and they deem the business to no longer be viable. There's nobody that wants to buy the shares of the corporation from them, or maybe it's not advantageous to sell the shares. So they want to basically just wind up the corporation. The corporation will no longer exist. So there's sort of three main steps. The corporation will dispose of the assets, pay off the liabilities, and then distribute whatever cash is left to the shareholders. Now, this is different from an 88.1. When you read your textbook, the textbook will refer to a Section 88.1 wind-up of a 90% owned subsidiary and an 88.2 wind-up, also known as a liquidation. Now, even though they both fall under Section 88, an 88.1 and an 88.2 are completely different. An 88.2, what we're going to focus on, is when the business is going to wind up, cease operations, liquidate, and there will no longer be a corporation that exists. An 88.1, the parent company will usually carry on the business. So completely different results. Now with an 88.2, what we're going to focus on, there's no tax-free rollover. The corporation will sell the assets. They're going to trigger perhaps capital gains. There might be a recapture. They're going to have to pay tax on that. So there's no tax-free rollover on an 88.2. Now, once again, generally the corporation will sell the assets, pay off the liabilities, pay any taxes, and then distribute any after-tax proceeds to the shareholders. Now, on the next slide, there's steps that need to be followed. So let's just go through the more detailed steps of an 88-2. The corporation will sell the assets at fair market value, pay off the liabilities. They're going to have to calculate what their taxable income and taxable taxes payable are. Remember, we said that when they sell the assets, there could be taxable capital gains, allowable capital losses, there could be recapture, terminal losses. So they're going to have to figure out what is their taxable income and figure out their taxes payable. Now, they should also update their refundable dividend tax on hand accounts and also the CDA if necessary. Remember, the CDA, the capital dividend account, if they have any taxable capital gains from the sale of those assets, the non-tax portion would be added to the CDA. And then they'll determine how much cash do they have available after they pay off all their liabilities and pay off all their taxes. Then they're going to basically redeem the shares from the shareholders. Now, when they redeem the shares from the shareholders, the amount up to the puck can be returned tax-free to the shareholders. Any amount over that will be a deemed dividend. Now, the deemed dividend, first of all, should be allocated as a capital dividend, an amount up to the balance in their CDA account. Because remember, a capital dividend is basically won't be taxed in the hands of the shareholder. And then the remainder will have to be designated as an eligible or non-eligible dividend, depending on the corporation's balance in their GRIP and LRIP account. And then finally, there could also be a capital gain to the shareholders as well. So that's sort of the steps that are necessary with a Section 88-2 wind up. Now, on the next slide, what I want to do is basically just review the common rollover provisions. Now, we've talked a lot about the different rollovers in Chapter 16 and 17, so this is going to be a brief overview of the different provisions and the common application of each one. So moving on to the next slide, let's talk about a Section 85. Now, a Section 85 was covered in Chapter 16, and we said the common application was, let's say, a sole proprietorship wants to incorporate, and they're going to transfer all their sole proprietorship assets to the corporation in exchange for shares in the new corporation. Now, there are other applications, but that's sort of the common one that we looked at in Chapter 16. Now, with a Section 85, remember the floor and ceiling value, the range had to be determined, and an elected value had to be made. And now the elected value could be anywhere between the floor and the ceiling, and that would be the deemed proceeds of disposition. And a taxpayer may not want to trigger any tax consequences, or they may want to take out some boot and also not trigger any tax consequences as well. Now, with a Section 85, the sole proprietorship might want to trigger some tax consequences. Maybe they want to trigger some taxable capital gains to use up some lost carryovers they have. So there's a lot more flexibility with a Section 85. And once again, the common application, a sole proprietorship wants to incorporate, so they're going to transfer their sole proprietorship assets to the new corporation in exchange for shares. So that's a Section 85. Moving on to the next slide, let's talk about the 85.1, what we talked about at the beginning of this video lecture, a share-for-share exchange. Common application, a big public company wants to take over a small company, and the shareholders of the small company will exchange the shares in the small company in exchange for shares in the big public company. Now, with a Section 85.1, no boot is allowed. It's just a share-for-share exchange. Everything is done tax-free, and those strict conditions must be followed. Moving on to the next slide, Section 86, share exchange in a reorganization. And we said the common application was succession planning. For example, the parent has built up this really successful business. They want to pass it on to one of their kids or maybe a key employee. They're going to give up their common shares in exchange for preferred shares, and they could take back some boot as well. Now, with the Section 86, again, the new shareholders, for example, the children, will buy the new common shares in that corporation, usually at a nominal value, at a very small value, and therefore all the future growth in that company will now accrue to those new common shares that the new shareholder, for example, the children, will now own. And the long-term shareholder, for example, the parent, may take back boot. Now, if the boot is more than the ACB or PUC of the old shares, then there will be immediate tax consequences. So that's a Section 86. Now, Chapter 17 also goes through Section 87 amalgamations and a Section 88(1) windup of a 90% owned subsidiary. Now, that is not covered in this video lecture, but a Section 87 amalgamation or a Section 88(1) windup of a subsidiary, usually what will happen is, with a Section 88(1), the subsidiary will cease to operate and will be rolled up into, for example, the parent company. Now, that's also known as a vertical amalgamation, and the reason that companies may want to amalgamate or to have a wind-up of the subsidiary into the parent is to maybe simplify the corporate structure. Now, when you go through the textbook, what you'll see is that under a Section 87 or 88(1), both provide tax-free rollovers, and there are strict conditions to be followed. Now, on my YouTube channel, I do have another video that talks about a Section 87 vertical amalgamation and a Section 88(1) windup. So check my YouTube video on my YouTube channel for that other video. Now, finally, we looked at a Section 88(2). Remember, we said an 88(2) and an 88(1), very different. 88(2) is a wind-up liquidation. Basically, the company is going to cease operations and dissolve. All the assets will be sold, the liabilities will be paid, any remaining funds will be distributed to the current shareholder. And once again, the current shareholder may want to retire and there's nobody to take over the company, or the company just has no viability operating in the future. So that's when an 88(2) would be used. So that brings us to the end of this video lecture. Now remember, to be successful, you want to make sure you review all the examples that your instructor does in class, review all the notes, do the exercises, do the self-study problem, and remember there's also extra supplementary self-study problems and practice exams included with this textbook. So that brings us to the end of this video lecture. Good luck with your studies, and we'll see you in the next video.